It's great to have you back on the show today.
Thanks,
Let's start with the comments that we were just talking about with Michael Cox, from Fed Chair Jerome Powell, also from Treasury Secretary Steven Mnuchin. How do you think the investment community is viewing what we heard from those two today?
Well, I think generally you have, we're in a recession, so we're going to have 2 consecutive quarters of negative growth. And one of the things that I came on to talk about is the rotation that comes out of that recession is usually into cyclical stocks. And when you look at what they talked about today, even if you take the CBO numbers of negative 6% GDP growth for 2020, that's about $1.2 trillion economic pothole. We've put now between direct stimulus, aid, and liquidity over $9 trillion of asphalt to fill a $1.2 trillion pothole. So I agree with Michael that certainly the back half and the first half of next year, we're going to see a recovery, and we're going to see growth levels maybe that wouldn't have happened without COVID because of the amount of stimulus and velocity that's going to hit in the system as people go to work and as demand comes back into the system, which we're now seeing. And fortunately, fingers crossed, the states that have opened up so far, the early states like Georgia, you're still seeing the cases decline. We know there's a 2-week lag, but that's promising. And we have flattened the curve. So even if we do see these mini spikes, the purpose of flattening the curve was not to cure the virus. It was to ease the burden on the healthcare system so we could deal with it as we move forward and as that demand comes back. And, even if we look at, Shauna, if we look at China, there was a note today, their oil demand is back to 13 million barrels a day from the 10 million barrel a day trough. That's near pre-pandemic levels just a few months later. And I think not only are we going to follow that trajectory, but we may be able to beat that trajectory because of what the Fed's done, what the US Treasury's done, and what Congress has done. So I fully agree with what Michael said.
Well, yeah, Thomas, it's interesting because while some states they aren't seeing a surge in cases, other states that have relaxed some of their restrictions, they are reporting a higher number of cases. You also have to, of course, counter in the fact that we are seeing more testing. But when we try to determine what the market needs in order to keep this momentum going, for the market to continue to push higher, what are the catalysts that you're looking for at this point?
Yeah, the last time I was on with you, Shona, we talked about, and you brought it up, there's a great point, the top 5 stocks in the S&P 500 making up about 0.25% of the weight. And there was a famous manager on last week, David Tepper, who said he feels that the market is the second most highly valued in his career to 1999 and 2000. And in the same breath, he said that he thinks the bottom is in. I tend to agree with both. So what we're going to need to see for these levels in the market to sustain, and if not continue to climb the wall of worry and maybe push higher, is a broadening of participation. So as I started in our conversation, usually what you see coming out of recessions, and this will take some time, is slowly but surely rates start to tick up. And that's where cyclicals start to outperform. I like to talk about sentiment a lot. Today, the Bank of America Global Fund Managers survey came out, and it was the most pessimistic view in 13 years on managers expecting value stocks to underperform growth stocks. And if we look at that thesis of the growth stocks being the second most fully valued in David Tepper's career, but the bottom is in order to fill that gap, we're going to need broadening participation. And that's why we've started to move into cyclicals off the correction. We like banks. We like actually defense sector stocks, which very few people are talking about, with the rhetoric picking up between the US and China. I think the rhetoric alone is enough to draw attention to the low valuation. That sector alone, if you look at the great financial crisis, fell 60% peak to trough. In this cycle, it's already fallen 55% peak to trough. So there's some good value certainly in banks. There's some good value in defense stocks. Obviously, home builders we're starting to see, and energy, low prices cure low prices. So I'll turn it to you, Shauna. Which do you want to talk about first?
Well, so Tom, that's interesting. You mentioned banks, the defense stocks, energy, home builders. When you try and identify, or when you are looking at those sectors, my question to you is, how are you identifying names that you're buying at this point? Because we've talked to a lot of money managers in the past, and they say that stock selection right now matters more than ever. So how are you reading that, and how are, I guess, what metrics are you looking at specifically when you're trying to identify certain names within these sectors?
So it's a great question. And how I look at it in this environment, because of the volatility and because of the uncertainty, I'm generally going way up the food chain for the highest quality equities that have just dramatically underperformed. So on the bank side, I like Wells Fargo. 50% of the banking revenues, everyone's looking at banks and they're worried about defaults and they're worried about net interest margin. Well, 50% of income revenues these days come from fee income. And if you look at the PPP program, which Michael was talking about briefly, banks are getting paid 1 to 5% origination fees on all of those loans. So in aggregate, just off the first round of PPP, the banking sector added $10 billion of earnings. That's going to start to show up in Q2 earnings. That's off the first round. Off the second round, the loans are much smaller on average. So rather than getting on average 2 or 3% origination fees, we're going to be closer to 4 or 5%. So when all is said and done by the second and possibly third round of, or something like it, of PPP, you may see 25 to $30 billion of aggregate earnings that no one's really anticipating, or I haven't seen worked into the models on the banking sector. So I'm on the high end of that. Wells Fargo fell 50% plus peak to trough in this cycle. I like US Bank Corp. They're a little bit more diversified in that sector. But that's number one. Number two, the second issue was defaults. And I think the Fed and Treasury have picked up the slack with the Main Street lending program. It's opened up capital markets. So it's really reduced the probability of excessive distress in the credit markets. And I think that will help banks. And then people were worried about consumers. And now they've just put out the notes on the TALF program, which is starting with $100 billion for consumer credit receivables, auto receivables, and that stuff. So it's going to keep credit flowing into the economy. And as long as we keep credit flowing in and demand comes back, that back half to early half of next year recovery is well within the cards.
All right, Thomas Hayes, Chairman of Great Hill Capital. Always great to have you on. Thanks so much for taking the time.
Thanks for having me, Shauna.